This is Lee Buckner, and in this video, I'm going to describe the Federal Reserve System and how the Federal Reserve System, through its central banks, can affect the supply of money in the economy. Before I do this video, please do note that I have a separate video on the effects of a change in the money supply. This video just focuses on how the Federal Reserve System and its central banks can change the money supply. So first, Federal Reserve System is a collection of 12 regional central banks in the United States. A central bank, think about it as being the bank for a bank. If a regular bank wants to be able to create more loans to give out to individuals or businesses, a central bank can help them do that. There are a couple of ways that central banks can help regular banks increase the amount of loans they have. The first and the most common and most powerful way is what's called open market operations. So all regular banks are going to hold a variety of different types of assets. Many of them are going to be bonds. If a central bank comes in and buys a lot of these assets, like bonds, from a regular bank, then the regular bank will have an increase in their cash reserves. With an increase in cash reserves, because they just sold some of their assets, they'll be able to lend out more money, which will cause an increase in the money supply. Two other ways that central banks can cause the money supply to increase are changes to their discount rate and also changes to the reserve requirements. Reserve requirements are the percentage of deposits the banks have to keep on hand, meaning they can lend out whatever else they get. Typically, this is going to be around 10%. If central banks were to lower reserve requirements, that means banks would be able to lend out more money, which would cause an increase in the money supply. This is possible, but very rarely done because changing reserve requirements is perceived as creating real instability in the banking system, which might make banks not trust each other, might make people not trust banks as a place to deposit their money. Generally, this isn't very commonly done and not a very good idea. The other thing I mentioned, the third major way that central banks can cause a change in the money supply is through what's called the discount rate. If a regular bank wants to borrow money that they can then lend out, it can borrow this money from a central bank. The discount rate is the interest rate that a regular bank has to pay a central bank for this borrowed money. If a central bank lowers the discount rate, which is, again, is the interest that a regular bank has to pay on that loan, then it's encouraging, this lowering of the discount rate encourages regular banks to borrow more money, and when they borrow more money, they will then ultimately create an increase in the money supply by lending more money out. Now, back to the Federal Reserve System. Again, think about the Federal Reserve System as a way that these 12 regional central banks within the United States can coordinate their actions. The Federal Reserve System has a charter which defines what their goals are. The basic way to think about the charter of the U.S. Federal Reserve System, and therefore its member central banks, is it wants to keep unemployment and inflation both low in the United States. Changing the money supply can lead to both of these things changing, both the unemployment rate and the inflation rate. So one of the main ways that the central banks coordinate their efforts through the Federal Reserve System is what's called the Board of Governors. The Board of Governors are going to have representatives from each of the central banks, as well as several federal appointees, which are going to be appointed by the President of the United States. And this Board of Governors will make determinations about what kind of national effects the Federal Reserve System and its central banks want to have. So, for example, if the Board of Governors determines that the banking system wants, the Federal Reserve banking system wants to bring unemployment down, it can encourage the central banks to increase the money supply by any of the methods we mentioned earlier. And then this would be a way that the Federal Reserve System can have the central banks influence monetary policy.